Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending January 6th, 2023. First really full week of the year for 2023. I'm Preston Brent, and thanks for tuning in. Well, where to from here? Well, there's a lot of different diverging views on where the markets are going to be going in the first half and the second half of 2023. So why don't we just get into it, just kind of take a look at how this first week fared. As you can see, everybody was in the green for the week. Year to date, everybody, it's the same thing. We've the weekly and the year to date's the same. PE ratio, the trailing is 18.42, forward is 16.92. It's lower by about 8.41%. You can see the dividend yield is 1.79. 10-year Treasury came in at Friday's close, a little over 3.5%. The earnings yield of the S&P is 5.64. And the earnings yield of the S&P over the 10-year Treasury is over 2%. So that'd be over 200 basis points. So that still encourages money into the equity market. However, everybody's lighting it up on equities. The real yield, even given the current interest rate, is still negative. And the current VIX closed out the week down at 21. The prior week it was 22.62. So it was down about 7.2% for the week. You can see the best performer for the week was communication services, which happened to be the worst performer last year. The worst performer for the week was healthcare. It really should be XLV, not XLE, coming in at 0.13. Just about every sector was up for the week. Communication services was also the best for the year, which is the same as the week. Healthcare, same, 0.13. It should be XLV. So really, after the end of year Friday, we had that little rally into close to finish off 2022, basically following an encouraging jobs report. The S&P continued to move with, kind of a relatively tight range compared to most of 2022. I can't talk. Within 2022, the index staying, roughly between 3780 and 3900. Pretty much since December 16th. Right? And the markets closed on Monday of this past week in observation of New Year's Day. So it was a holiday shortened week, but the week had a lot of closely watched economic reports that hit the tape. And the market's reaction seems to signal that investors' preference for slowing growth and slowing inflation over a robust economy seems to be a natural trade-off with what the Feds are going to be doing. Now, both the S&P and NASDAQ both fell over 1% on Thursday when we got our payroll data from ADP showing an increase of 235,000 in jobs. So just understand we're in a good news is bad news and a bad news is good news kind of market. And then on Friday, this past Friday, we got jobless claims fell unexpectedly to 204,000, but slowing wage growth kind of helped move price action up because it would imply that will be good for reducing inflation, which in turn would be good for the Feds to ease off on the accelerator for raising rates. So that's what kind of drove the markets up. We also got the supply management index, services sector. The activity fell to 49.6. That was below consensus. Remember, contraction territory is 50. So all of these things helped bad economic data, portended good price action moves, right? So all of that was a good thing for price action. And we had a strong finish, as you guys know, on this past Friday. Okay? And we also had this slowdown in the services sector appeared to send both short and longer term treasury yields a lot lower Friday morning. And that kind of left the 10-year treasury note, as I said, lower for the week. It came in at 3.56%. Okay, so that was all in a good thing. And then, of course, if we come over and look at how Europe fared fairly well. Everybody was in the green for the week. So a good start to 2023. You can see all across Europe, the Euro stocks, FTSE, CAC 40, the DAX, all solidly in the green. Of course, like the US, the year-to-date number is the same as the weekly number. The only one that had a little bit of a drawback in the first week of the new trading year was the Nikkei, but just down barely 45 basis points. But otherwise, China, Hang Seng also up nicely, giving everybody pretty much a green start to the week. Okay. And if we do look over there in Europe, we're seeing some of the decline in energy prices helping push Eurozone inflation below 10% for the first time in a couple of months. I mean, the CPI in December rose 9.2% year over year, right? Estimates were 9.7, so it's a little bit higher than everybody thought, but still coming in less than 10%. Even so, core inflation, which, like here in the US, we take out volatile food and energy, alcohol, tobacco, that kind of thing, kind of moved up from November from 5% to 5.2 in December. So they're having a harder go of it with inflation than we are here in the US. And we did see their composite PMI, which includes both services and manufacturing across the Eurozone. It was revised higher to 49.3, again below the contraction level of 50, but the estimate was for it to come in at 48.8. So a little bit better than estimate, but still in contraction territory. So that kind of goosed the markets into thinking possibly a softer inflationary kind of environment, right? So that obviously added to the green on the screen, right? And then in Japan, you can see it was the only one in the red to kick off the new year. They conducted an unscheduled bond buying operation to help defend their newly increased 50 basis point cap on their 10-year. Remember when they did that in December, later in December. So they finished the week at that level up about 42 basis points from the previous week. But it basically, pressure on the cap of their interest rate kind of reflects investor expectations that the BOJ is going to increasingly pivot away from their ultra loose monetary policy stance. We will see, because they've had that on for quite some time. Meanwhile, in China, the economic news continues to be really ugly, primarily because they shut down again with COVID. Now they're opening back up. I think the people over there are pretty much rioting, which is why they're opening back up. President Xi's putting that on. But their overall PMI data for both manufacturing and non-manufacturing, that would be their composite index, it fell to 42.6 from 47 in November. That is ugly, ugly. That's the biggest decline since February of 2020, which of course is when they shut everything down for COVID. Okay. So, but even given all of that, China managed to finish in the green for the week and obviously year to date. And as they announced, they're abandoning their zero COVID policy approach. So these are things that are going on right now. And if I switch over to the E-mini S&P 500 futures, let me just get it on the screen for you guys. It'll take about 15 seconds to pop up. You're going to see we've been in, like I said, since about the middle of December, we've been in a tight trading range. You can see coming all the way back over here to the 16th, it's just up, down, up, down, up, down. And I've got it highlighted now to kick off the new year, the 2022 closing price of 38.68. And this is the E-mini S&P 500 futures. You can see we finished up in the green on January 6th, up a little over 1.57. Now, this is not the closing price. That's the intraday high, all right? So we hit 39.2875. And our low for the year was actually on the first trading day of the year, okay? And it's really not January 1st. It should be January 3rd. So let me put that up there and just edit that for you guys and just say that was January the 3rd. We'll just get that all squared away. So it'd help if I had the number on there, wouldn't it? So let's get to January the 3rd like that, and then we'll get that all set. So that was the low, but you can see, as I told all of our members, we got key data coming up this week and on February the 1st. That's going to determine where we break out. These shaded zones here represent, this is an R1 level, a resistance level up here, just sitting slightly over 4,000. And the S1 level here, which is in some respects, after we broke through it, an R1 level, which would be the first level of resistance, but we're sitting right on it right now. You can see that red line is a 50 SMA moving average, and we're slightly above it for the E-minis, okay? So if we're probably going to stay jammed in this level here until we get through the CPI data this coming Thursday at 8:30 in the morning Eastern Standard Time. So any of you may have some profits on small profits in any type of trade. Be wary because the last 4 CPI monthly data prints for the previous month's inflation, we've had the S&P move almost a little over 2%, 1.5% to 2% up and down every day, and that would give us a 50-point move, roughly, maybe a little bit more in the S&P on Thursday. So if it comes in good, meaning inflation is coming down more than estimates, and core inflation, which is what the Feds follow, are coming down more than estimates, you can pretty well bet we're going to start working our way up to this R1 resistance level around 4,000. Okay. If it comes in still relatively hot, and we get the Feds, because they're still out talking in front of the press, where they're still going to be very aggressive, because right now it's the Feds versus the market expectation, and they're slightly divergent. And members, this Sunday evening, we'll kind of go over where I see 2023 with some opportunities and what this divergence means and where we got to watch out. But again, we've got the CPI data coming out Thursday, and then we have the Fed's meeting on February 1st, first day of February. And the odds favor anywhere from right now it's a little over 40% that they could do a 50 basis point rate hike. Some of the market participants think 25. So it's enough of a range where there could be a surprise. It could be a good surprise or a bad surprise. If it's a hawkish surprise, we're going to come back down and probably make new 2023 lows. As most of my members know, I do believe in the first half of this year, we will make new lows, probably taking out the 3,500 level, which is more than 300 points south, 400 points south of where we are right now, roughly. But we need the catalyst and the trigger to do that. Should we get different views on CPI and the Feds change their tune, then I'm going to change my tune. But that's the way it's looking right now. Okay. So that's a little bit about the S&P 500. And of course, NASDAQ, it had a really, really ugly year last year, primarily because of, and we'll look at NASDAQ 100, which is all the tech companies. And you could see I had a target level down here, this big colored bar, and we're near my target. You can see where we're just barely, there's a 2022 close. So we finished in the green because we're above the close of 2022. The high price was intraday 1.27. The low also not quite on the same day. Well, the low was on the same day. The high price was in the first January 3rd of the year. Low was made on Friday, but we closed up very nicely. So we're going to break out of these ranges, and just like the S&P, it depends on where the Feds are going to go, right? And that's kind of what I'm looking at here. And then, of course, if we come down here and we look at the VIX, and we look at it for where we're sitting, notice the 50 is below the 200. And the 50 being below, and these are EMAs, that is a nice sign for the VIX coming back down again, right? I mean, this is a good sign, but every time we've gotten down to these lows down here, and this goes all the way back to January of 2022, right? Let me just swing it all the way back. This is a daily chart, but I'll take it back to January 2022. You can see this chop. It's just a rising, moving higher and lower between a range that runs from about 36 in the VIX down to about 19. So, which is right around my color change band around 20. So we're working our way back down again, and this could set us up for another move. Now, understand, this coming Friday, we also kick off that all-important earnings for Q4. It's going to be a heavy bank day. We get Bank of America, Citi, JP Morgan, Wells Fargo, Bank of New York Mellon, and BlackRock, which is really not a bank, but it is a big money center institution with a lot of money. And we get First Republic Bank as a regional as well. So we get a ton of big money center banks and regional banks kicking off on Friday, and all eyes are on Q4. Estimates are for earnings to come down because our PE ratio has fallen as much as it has. I would suspect that the bar has been reduced dramatically. But if earnings start to come in lower than estimates, but it's not as much Q4 as it is the forward guidance. If forward guidance in Q1 and Q2 of next year also come down, and they've already been written down over 12%. since the summer of 22. Okay, but they've already come down. If they come down even more, then we're rolling back over. So there's a lot of things that can move the market lower, that no matter what the charts say, that's what's going to happen. So that would explain why we're in that tight chop range. And of course, if we look at the bond market, it was up big time on Friday, right? And you can see here my estimate for bonds. Let me just get that 200 and the 50 lined up here. You can see on this Elliott wave pattern, it's going to suggest we're moving back up here, which would mean interest rates are moving lower. Money is coming back into the bond market, unlike 2022 when bonds were down and equities were down, which is one of those rare years where they both go in parallel. There was no place to hide in 2022, unless you were in our group and you followed our trades. We did over 20% returns on what we do. But you can see here that I'm estimating, and it's showing that we should expect a little bit of an up move in the bond market in the second half of January. So we'll see where that goes. But remember, bonds are severely affected by CPI and the Feds. So it would indicate on the charts that rates are going to come down, and bonds, meanwhile, are going to come up. We'll see how it plays itself out. 10-year rates, as I said, coming down. Here we are right here. We broke through the 50 EMA. We're going to find a little bit of a support element right here. And let's see where we go, okay? The US dollar, well, the US dollar, as I told our members, look at that. The dollar is ugly. Right over in this area here, I had our members going long the euro. And we've made a lot of money. Some of our members have made a ton of money going long the euro or euro dollar or euro futures, or doing one of our specialty trades in the options market on euro futures. We've got a number of different ways to play this one, but the trigger was back in October, or I'm sorry, early November. And I called it a low-hanging fruit trade. It's just, the fruit is very low on the tree, very easy to pick, very ripe. It just shake the limb and they fall off into the basket. That was this kind of trade. And if we look at the euro, you're going to see here, and I even pointed this out to a number of people in our free group here, right in that area there. As soon as we took it out, I told our members to get long for the members that wanted to be safe. The ones that didn't want to take a little bit more risk, they would have gotten long back over here in October. Okay. But boom, away we went. And we're testing the 200 EMA. You can see right here, multiple tests, but I just think the euro wants to go higher. Any pullback on the euro, you want to buy the dip. Okay. And then, of course, if we come down here and look at gold, as I told most of our members, we want to be long gold this year. But look at this. I mean, I'm going to adjust the closing price and the high and the low for gold, because that's another actively traded commodity we like to play. And we're off to the races. So we're also getting that. You can see here on Friday, we're starting to get that cross in the 50 and the 200, which takes away from that bear market look. And I think gold is going to be back up over 2,000 before the end of the year. Same thing with silver. Copper, it all depends on where China wants to go. You can see copper is testing nicely this 50 EMA. My original forecast for copper was way down here, but China, once they did that zero COVID opening, and it's kind of a vote on where the global economy is going to go. We tested this twice. We moved up. That's just a classic buy signal on copper, or FCX, right? And then, of course, with energy is still very tricky, but it works out nicely for our trades. Remember, my forecast for energy was back down here, back down around 67.80 a barrel, coming close to challenging the 2022 price. Low price, I'm going to adjust this to the 2022 closing price, but I do believe that this is going to find a lot of support down in this level here, and it'll set the stage for moving a little bit higher. Okay, so that's a little bit about energy. If we look at nat gas, I think nat gas was another home run trade for us. We've had some pretty good trades in the commodity space. Look at nat gas. I mean, it just fell off the table again. It's coming right down to my target, down around 323. Back up over here is where I was talking about getting short. I said any move up here would be a short trade. We took out the 50. Now look at the 50 going below the 200, another trigger, and it's just take the trade to the downside, right? So for the members that are taking these trades, they're making a lot of money. If you're just watching the free weekend update, then that's good. You probably get maybe a week or two late on some of these trades, but they're still really solid trades, right? So that's a little bit about what I'm looking at for the year. As far as where the markets are going to go for 2023, members, we'll go into this in a little bit more detail in our Sunday night session, and I'll show you some setups and some option strategies that'll play nicely in 2023, just as they did for us in 2022. All right, everybody, have a great weekend. And members, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao.